Hey, what's up, guys? Welcome back to the channel. My name is Frank Mularcik, and welcome to episode 19 of my Dow Analysis series. In this video, we'll be analyzing the 15th largest company in the Dow by market cap, which is Verizon, ticker symbol VZ. And as some of you might know, Verizon stock has actually sold off quite a lot recently, and their market cap has been surpassed by two companies in the Dow that I have analyzed already in this series, which are McDonald's and Disney. So I'm pretty excited for this one because of that recent sell-off, and I encourage everyone to stick around towards the end of the video to see what I think the fair value is for Verizon stock. So the first thing that I like to do when analyzing a stock is to learn a little bit about their business. So we're going to go through their business right now. So Verizon is one of the world's leading providers of communications, technology, information, and entertainment products and services to consumers, businesses, and government entities. They offer data, video, and voice services and solutions on their networks and platforms that are designed to meet customers' demand for mobility, reliable network connectivity, security, and control. So that's basically what they do in a nutshell. Their business is structured into wireless services and equipment. Those are their basic offerings, which they sell to their customers. So they do offer postpaid and prepaid services. The prepaid service is really only available to customers in the consumer segment as opposed to businesses. But the majority of their services are through postpaid connections, which means you pay a monthly cell phone bill essentially, or some other network or wireless network bill. So that accounts for about 79% of the consumer sector, and the majority of their prepaid connections, which is where you kind of pay a set amount up front, and that gives you, a cell phone plan or some other similar plan for a duration of time. Most of those are due to their acquisition of TracFone in late 2021, which I think is pretty interesting. So like I said, Verizon kind of splits their business into the consumer group and the business group. So within the consumer group, obviously they have all the wireless services mentioned before, but they offer a lot of residential connectivity as well. So they offer fiber optic networks through their Fios product, and then they also have traditional copper-based, wired internet connectivity services. And then they're also offering 5G fixed wireless technologies for homes, which is now available in parts of 65 cities as of the end of 2021. I don't really know what exactly that entails. I think that's just kind of like 5G coverage within the home specifically, but I don't know a lot about that. I don't know a lot about 5G in general, I guess, but I think it is an interesting technology for sure. And another interesting thing I think is that within their consumer segment, they actually sell network access to what are called mobile virtual network operators, and those businesses then resell those wireless services to their own customers under their own brand. And within the business segment, they offer more tailored solutions for businesses that really help them communicate more effectively and do business more effectively. So they do offer, private networking and cloud services, security services, Internet of Things services, and much more. And those are really vital for lots of businesses to make, what seem like simple things happen very easily. And I think those are just, important services for a lot of businesses, and a lot of businesses probably rely on stuff like that. Another thing that Verizon does is selling communication services wholesale to other companies. And they mentioned that some of these companies that they sell communication services to wholesale are actually competitors with Verizon, which I think is interesting. But in general, just looking at their business as a whole, the consumer segment currently provides about 3/4 of the revenue for Verizon, whereas the business segment provides about 1/4 of the revenue. So now that we know a little bit about Verizon's business, we can talk about how that business is actually doing. So Verizon recently reported at the end of July their second quarter 2022 earnings results. And basically, their revenues for the quarter, the second quarter, were $33.8 billion, which is pretty much flat compared to the second quarter in 2021. And earnings per share for the quarter were $1.24, which is about 11% lower than the $1.40 that they had in the second quarter of 2021. Looking at free cash flow, that was about $17.7 billion for the first half of 2022. They talked about that in terms of the first half of the year as opposed to quarterly basis, and that's actually 13% lower than the $20.4 billion of free cash flow that they generated in the first half of 2021. So definitely a little bit of a lag in earnings and free cash flow. But they did mention some interesting things in the earnings call, which I listened to. And one of those things is that they are kind of pursuing a dual strategy when it comes to pricing. So they're increasing prices on some of the premium plans because of inflation, but they're also starting to offer some other plans that are kind of bare bones without, some of the premium features, and they're offering those at a much lower price point so that consumers that are, maybe struggling a bit because of inflation or, need some basic, wireless services, but don't really have the ability at this point to pay for a higher price point, that they have the ability to purchase that more affordable plan. And I think that's really a good strategy. It makes sense to me to go after, a larger market essentially. And also on the earnings call, one of the people that asked questions was asking about issues that at&t was having. So at&t reported their earnings a few days before Verizon, and they talked about having some trouble collecting, payments basically from customers. Not necessarily trouble, but some of their customers were paying later than normal. And so someone on the earnings call was asking if Verizon had similar issues, and Verizon basically said no, that really hasn't been an issue for them at all, which is definitely good to hear. I think this earnings report in general was a bit disappointing because they really didn't meet their expectations or analysts' expectations for the quarter. And some of those numbers are just lagging a little bit from last year, which we definitely don't like to see. And another thing that isn't as good to see is that they did lower their guidance for the full year of 2022. And again, that just shows that they're not really as confident anymore in their ability to perform well this year. And now we are going to look at the balance sheet, which I'll show up on the screen here. We can see that their current assets are up just about $1 billion since the end of 2021 to $37.5 billion. We can see also that they've reduced their cash position by about $1 billion, which is something that most companies in general have been doing this year. When we compare that to the current liabilities of $49 billion, we can see that the current ratio is 0.76, and that basically means that they don't have enough liquid assets at this point to pay off all of their liabilities that will be due within the next year, and that's definitely not a good thing to see in general. Looking at total assets, those have increased about $3.5 billion to a total of $370 billion, which is certainly a good sign. They actually don't list their total liabilities, but we can find that out by adding the current liabilities of $49.2 billion and add that to the long-term liabilities of $233.6 billion, and that brings us to a total liabilities of $282.7 billion, which is actually down about $600 million since the end of 2021. So it's definitely a good thing to see that total assets are increasing just a little bit, total liabilities decreasing just a little bit. But we also want to look at debt because in general, that's something that a lot of people are concerned with these telecommunications companies like Verizon and at&t. And again, they don't list the total debt, but they have listed the debt that they owe within the next year, which is right here. And then they also list the long-term debt right here. And when we add those up, we get a total of $149.1 billion. And a little bit better way to look at this is through net debt. And in order to find the net debt, we basically just subtract their cash position out of that. And we find net debt is $147.2 billion. And we can compare that to net debt from last year. And we can see that net debt is really only down about $700 million, which is better than nothing for sure. But really not the type of decreases that I would like to see in general, when that's, less than 1% at that point of debt that they're reducing. We can also look at the debt to equity ratio, which we basically find by taking the total debt and dividing that by the equity. And right now that gives us a ratio of 1.7, which basically means that they're financing their business more so through debt than through equity. But I think it's important to note that that's 1.7. It's really not all that high in general. If you say a company has $150 billion of debt, most people would think, wow, that's a lot. But when you compare that to their equity, it's really not all that much. Obviously, it's almost twice the debt as equity, but again, it's really not, like 10 times or something crazy like that. And if we look at the debt to equity ratio last year, it was actually 1.8 at the end of 2021. So it has seen a little bit more significant reduction in that debt to equity ratio, which is definitely a good thing to see for sure. So in my opinion, the balance sheet isn't the best. The one thing that I really don't like is that current ratio less than 1. But even though they have been reducing debt, it has been slow, which is also, not the best thing to see. I would really like to see them, work a little bit harder on decreasing the debt and hopefully bring that down a little more quickly. So when we look at the dividend right now, Verizon is yielding 5.5%, which is for me on the high side. I would say that's pretty high for a dividend. At least for companies that I do own in my portfolio and my kind of goals for my portfolio. I would say that's on the higher side. And when we look at the dividend growth, I would say that's on the lower side and very low right now. Over the past 5 years, they've averaged 2% dividend growth. And this is what I would call a red flag because for me, at my point in my investing, I really value a growing dividend a lot more than a higher dividend yield. But that doesn't mean that's the right choice for everyone. Definitely, if you are older or for some reason you just are relying sort of on that dividend income, or you will be relying on it sometime soon, then a higher dividend is certainly attractive, and at that point the dividend growth isn't as attractive. But for me, I think the growth aspect is more important, and I would definitely like to see more growth from Verizon. When looking at the payout ratio, though, it is very healthy at around 50%, and this is the earnings per share payout ratio, but I think the free cash flow payout ratio is around 50% as well. I actually didn't do that calculation, but I will put that up on screen here as well. They have been growing the dividend for 18 consecutive years, which is a fairly decent track record. Definitely not the best out there, but hopefully they will continue raising the dividend. I think they will, even if the dividend raises aren't that big. I think they'll definitely continue raising the dividend. And overall, I think the dividend is very safe. I don't think they're going to cut it, but it's just not as attractive to me since for my portfolio, I'm sort of looking for companies with not as high dividend yields necessarily, and in most cases, I would like to see higher dividend growth, averaging around 8%, which is really my goal for my portfolio. So now that we know about the company and how they've been performing recently, we can start to look at some valuation metrics. And the first one I like to look at is the PE ratio. And looking at a trend since 2015 of their PE ratio, the average PE for Verizon has been about 10.5, and right now that PE ratio is around 9. Usually I look a bit further out for the PE ratio, but right now I'm just looking since 2018 because they had some very low earnings and actually negative earnings in 2012 that kind of skewed the PE ratio in that time frame. So I don't think it's really beneficial to look at the PE ratio over a longer time frame that includes that data. But aside from that, earnings have generally been increasing, as we can see here. Obviously, they had a little bit of a spike in 2018 and have since declined from then. But like I said, in general, the earnings have been growing. I also think it's important to compare Verizon to their peers. So they are in the communications sector, and that sector has an average PE right now of 18. And within that sector, they are in the telecommunication services industry, and that industry has an average of 13 for the PE right now. So in both cases, Verizon's PE of 9 is a bit lower than both their sector and industry, which is definitely a good sign for showing that Verizon could be undervalued at this point in time. Another valuation method that I really like is a discounted cash flow model. And using this method, I calculated a fair value for the stock of $52.63. And if we use a 10% margin of safety, that gives us a buy price of $47.36. And right now, the current price of Verizon is around $45, which makes it look like Verizon is just a bit undervalued at this time. And when we look at a 3-year chart right here of Verizon, the first thing that I see is that they're well below the pre-pandemic highs and even below the lows that they reached in March 2020. So during the March 2020 crash, the stock bottomed around $48, and now it's below that at about $45. They reached a low of in the range of $43 just a week or two ago on their earnings report. When we look at the 1-year chart, it really doesn't look better, really just in a downtrend, really struggling to break above any sort of support or moving averages. Now we can see the stock really fell off after their first quarter earnings at the end of April, and since then they really recovered a fair bit. But their second quarter earnings reported just a few weeks ago, and the stock fell drastically again. And it was actually pretty interesting to see how that happened because AT&T reported earnings a day or two before Verizon, and AT&T didn't have the best earnings, and so that made investors wary of Verizon, which has a similar business. So Verizon sold off, around 5%, I think, on the day that AT&T reported earnings, and then when Verizon had bad earnings, then they sold off even more. So I think that was pretty interesting for me, and I think in general the stock technically it looks pretty weak, and I really don't like where it's at right now, but it is, lower in a sense than where it's been in the past, which could be a good thing as well. Verizon certainly does have a very strong business model that provides products and services that are essential and integral to everyone's day-to-day life in the US. Like I was saying before, some of their products just make life so much easier without us really realizing what goes into that. And so I think, their business really isn't going to go anywhere. They have plenty of business, but they definitely have been struggling to grow revenues and earnings the past few years. I do like that they are trying to expand into 5G, newer technologies, fiber optics, and other new technologies. But at this point, it's just requiring a lot of upfront cost, and that really hasn't paid off for them that much yet. So that's definitely something that could pay off for them in the future, but it's a little bit uncertain as to whether it will. Another thing that I thought was pretty interesting that they did mention in the 10K is that, as a business, Verizon views some of the more popular tech companies like Apple or Google or Meta as competitors because they have communication services that sort of bypass the traditional wireless communication network. So, for example, with Apple, you can FaceTime people. With Google, they have, Google Hangouts and chats and emails that, in a sense, bypass the traditional wireless communication services technologies that Verizon supplies and relies on for revenue. So I think that's definitely an interesting thing to keep in your head when you're thinking about Verizon. And they also did mention something about low Earth orbit satellites that are providing wireless connectivity, which almost to me seems directly targeted at what SpaceX is doing. So I think that's pretty interesting, and I think it's definitely good that they're recognizing that those are threats, and hopefully they can mitigate the effects of those threats on their businesses. In terms of their balance sheet, like I said, I don't think it's the strongest, but I really am looking for them to improve the debt situation. But unfortunately, I really don't think the debt situation is going to improve that much, at least in the next few years. In terms of the dividend, I think it's very strong, but it's just not growing very quickly, and that's something that really doesn't excite me at all. In terms of the valuation, I think the $45 price that we're at right now is really solid. I think $55 is really where the fair value of this company is. But for me, I'm just not really interested in investing in Verizon at this point, just because most of my investments in individual stocks are for the purposes of dividends, and I just really don't see them as being a long-term dividend stock that I do want to hold. I do have a small exposure to the telecommunications industry through AT&T, and that is not my favorite investment either, and I don't think I really want to expand that exposure to that industry either. So let me know what you think of Verizon down in the comments below. I would love to hear what you have to think, and I would love to hear if you did buy any after the recent sell-off at the end of July. Just want to thank everyone for sticking around to the end of the video. It really does mean a lot, and I'll see you all in the next one.